Ladies and gentlemen, the role of retirement funds as owners of capital to advance and broaden economic participation is going to be presented by Mr. Duma Gqubule.
Thank you very much. Charlotte told me that I am standing in between lunch and so I have to be very quick. It's such a pleasure to come to this province. I was remembering when I first came to this province, I was about 11 years old and we were traveling from Umtata to Pietermaritzburg with a family. And our major issue was with Pumla, Dr. Mganga, my sister. Our major issue was, Mom, please teach us how to speak isiZulu. Fast forward now, I speak better isiZulu than isiXhosa. When I go to the Eastern Cape, people laugh at me. But anyway, I just want to start off by thank you for all the fascinating conversations that we had earlier on. And I'm not even sure where to start, you know. Like Mr. Zongo, I'll dispense with the presentation. And just some notes that I was thinking as I was talking is that, number one, we talk about there's this quote, everybody's talking about infrastructure. And there's a quote that I saw by an economist, a Nobel laureate. His name was Robert Solow. He says, the computer age is everywhere except in the national statistics. And that is how I feel about infrastructure. Infrastructure is everywhere except in the national statistics. And I just want to see a quick analysis I did after President Ramaphosa's investment conference. We've had these investment conferences since 2018 until 2025. So I did a quick analysis of what we did and then I went to the first one. The biggest commitment was from De Beers for the Venetia mine. But that mine had started in 2013 and it had already almost been finished. The mine has shut down now for 2 years. So I just said, I will never go to these conferences again. So if we look at the impact of these conferences, infrastructure must keep up with the growth of the population and inflation. What has happened since between 2018 and 2025? Per capita gross fixed capital formation collapsed by 23%. Per capita general government investment collapsed by 22%. Per capita investment by public corporations by 32%. And by public investment, total public investment was down 26%, and per capita private investment was down by 20%. So that is the reality that we're talking about as a country. And, you know, I hear people talk about PPPs. If you look at every budget for the past 25 years, the number is the same. It's the smallest component of public investment. This year, it is 2.5% of public investment. And I was telling my sister, I'm beginning to wonder whether they're counting the same PPPs and there are no new ones, because I'm beginning not to trust the number that we see in the budget. Anyway, sorry, with those introductory, you know, I just want to say, firstly, we've had 32 wasted years. GDP per capita increased by 22% from 1994 to 2024. Look at the comparison with China, 779%. Rwanda, 422%. Vietnam, India, Ethiopia. So our economy has been a story of two halves. Our GDP growth grew by 3.6% a year from 1994 to 2008. President Thabo Mbeki likes talking about this. And then we collapsed to 1.1% GDP growth from 2009 to 2025. By comparison, this is a period that included the global financial crisis and the COVID pandemic. We had emerging and developing countries, 155 of them, they grew by 4.4% a year. At the end of last year, I was in Malaysia, and they've got 3% unemployment. And I looked at what would have happened if South Africa had grown by 4.4%? And I looked at what was Malaysia's growth over the same period. It was 4.4%. What would have happened to South Africa if we had also grown at 4.4%? We would have had unemployment of 5.7%. Emerging and developing Asia, 6.3%. By political administration, the current one, you talked about the President Ramaphosa, is objectively the worst performance since 1994. And I'm not hating, it's the facts, you know. And then if you want to look at, by economic policies, basically the economy grows and creates jobs when the government invests in its people and its infrastructure. So just to summarize, between 2003 and 2008, we had a boom. Well, by South African standards. This is not a boom by global standards. We had 4.8% growth in government consumption spending, public sector investment, 14% a year. So what we learned from this is that public sector leads investment, when you unpack those numbers, and private sector investment follows. And what happened? We grew by 4.5%. Now, all that has happened in the last 17 years, can we please focus, South Africans, is that the government stopped spending on its people and its infrastructure. Gross government consumption spending, 1.3% a year. And then we have a public sector investment strike. Real per capita public investment collapsed by 43%. And if you have to put a gun to my head and you say, I don't like simple solutions, single solutions for complex problems, for many problems. But if you had to put a gun to my head, we've got to invest in infrastructure because it makes no sense for the government not to invest on infrastructure. So I have to talk about, so basically we are an unviable society. We've got the second highest unemployment rate in the world after Swaziland, and this is the roll call of the disastrous statistics of our economy. 7 million unemployed young people, the second highest youth unemployment rate in the world, and so I can continue and continue. And I just want to talk about the drivers of unemployment. There was a time when we created 3.1 million jobs from that period that I talked about, March 2003 to December 2008. We created 3.1 million jobs. The unemployment rate came down to 28.7% from 40.6%. One thing that was driving the reduction of unemployment is that the labor force was not growing as fast as it usually grows. And I talked to Dr. Lehot, and we speculated that it could have been because of the AIDS crisis. So after, this is the sectors that were creating jobs. Every single sector created jobs except mining. The sectors that created jobs were the ones that served the domestic economy. And then we look at the labor market statistics the last 17 years. What we see is that the labor force grew by 9 million people. We create only 2 million jobs, the number of unemployed people by 7%. So that's basically what's happened here. But we've had jobless growth for young people. I'll just quickly go to the KZN labor market. So what we see in the KZN labor market, the stats came last night at 10:30 from the Stats SA. But anyway, so the labor force, from 2003 to 2008, the labor force contracted by 109,000 people. And then we created 356,000 jobs. But I want us to look at the last 17 years. So the last 17 years, the economy has created 138,000 jobs. That is 8 jobs on average per year. How many, this was dumbfounded me, that we have only created an average of 8 jobs for the whole province per year. We cannot continue like this, yeah. And then this is just showing the sectors that create jobs. If you look at these sectors that create jobs, it's exactly the same as national. It's finance and community, which is mostly government. So finance grows, if you look at the past 30 years, finance has grown by 4% a year, far faster than any other sector of the economy. It's what we call financialization, and we believe it's too much financialization. And then government and so forth, yeah. And then what are the levers to reduce this unemployment crisis? We have to have higher GDP growth. We have to have a higher industrial policies to change the employment multiplier, the relationship between GDP growth and jobs, and we have to expand our public employment programs. I'll just quickly, so people must understand the scale of the overlapping crisis. We can't aim a water pistol at a blazing inferno of unemployment. Getting 13 million people to work is equivalent of a war effort. According to my projections, the economy over the next decade, the labor force will increase by 758,000 people every year. To create jobs just for the annual new entrance into the labor force, we have to grow by 4.6%. That is the scale of the crisis that we have, and let alone the people who are already employed. So GDP growth as well will not be enough to create these jobs. We need to create 1.8 million jobs a year to create full employment by 2035. This is the reality that we're talking about. And I believe I've been talking to many South Africans as to how we can achieve this higher growth rate. But the main issue is that we need to have a mobilizing vision and plan for this economy. That is what is missing. We have to have a new macroeconomic policy framework that's got a minimum GDP growth target of 6% a year that is binding on Treasury and the central bank. What we have currently is that the Treasury doesn't care about GDP growth, it only cares about its debt targets. The central bank only cares about inflation, it doesn't care about jobs. Nobody is responsible for this jobs crisis, and we can't continue like this. So all that happens, Mr. Zungu was talking about China. They set a target every single year, and they have met it every single year except during COVID for 40 years. Why? Well, how do they do it? I've been to China twice. I spent about a month in China on study tours. And basically, they have a target, and they throw the kitchen sink at the problem. So in September 2024, they thought that they're not going to meet the target of 5% growth. And they responded with a massive stimulus to the economy, and they achieved the target. And that is what we need to do. We have to focus on this jobs crisis. The NDP targets public investment 10% of GDP. Total investment last year was 13.9% of GDP. Annual shortfall to achieve the NDP target is 1.1 trillion. Public investment shortfall is 500 billion a year. We must increase, and then when the government says we're spending $1 trillion, when I look at the numbers, the public investment, that trillion, when you look through the smoke and mirrors, public investment declines for 5% a year over that period in real per capita terms. So, I don't know, man. It has collapsed by 43% over 17 years, and they're going to continue doing that for another 3 years. It makes no sense whatsoever. So we must increase public investment. There's a whole lot of things that we have to do. But the one that I feel strongly about as well is that industrial policy. We've got inadequate spending on industrial policy. Usandile talked about SME finance. We've got an SME financing gap of about 350 billion rands. But the SME, the BASA report says banks' balance sheets to black SMEs was 40 billion rands, or 0.5% of total assets. Now, what that means is that we're not dealing with normal risk aversion that you see in every country in the world. You're dealing with, I believe, racism, and we need to have developmental targets for the financial sector. So just quickly, I just want to finish this. What really gets me angry is the soap opera at the PIC. They're getting tripped up by one investment, 400 million. This is an asset of 3.7 trillion, and then they're getting tripped up, the whole board, around whether there should be 3 CIOs or 1 CIO. And then the whole board is resigning. No, guys. We should be talking about what is the role of this institution in our economy. It's got assets of 3.7 trillion. And then if you add our Eskom pension fund, and then you add Transnet pension fund, and then you add also the municipal pension funds, you're talking about a lot of money, capital, that is under control of the government. And the last time I did that calculation, it was about 40% of retirement funds, like 40+% of retirement. So I say, this one just gets me angry, but I just say, there's not much time, but we have to restructure what I call the SA Inc. balance sheet. We've got this 3.7 trillion at PIC. We've got foreign exchange reserves of 1.2 trillion. We've got cash of 200 billion in the budget. So, Minangiti, if you just give me a little bit of time to explain what I said. So in 2016, a decade ago, an economist called Niva, she brought our attention to a surplus on the UIF, and it was more than 100. So she said, let's spend that surplus some of that surplus to stimulate the economy. And COVID comes, National Treasury couldn't come with a reason why we should have this surplus. At Nedlec, I go to Nedlec sometimes, and we spent 60 billion rands from that surplus, and we paid people, 13 million people who were temporarily unemployed, and guess what? In that kitty now, there's 140 billion rands. So I've been talking about these surpluses for so long. The CETA surpluses in the National Skills Fund, it's 60 billion. And I've been writing and talking about this for a long time. And I was very happy that I got support from an unlikely source, the DA, which is saying we must spend the CETA surpluses, the compensation fund surpluses, and so on. So I'm just saying that we are in trouble as a country. And the last thing I just want to say is that I believe that there's excess capital in this pension fund. So if you look at this pension fund, it has accumulated surpluses of 674 billion rands over the past 13 years, and 52 billion rands a year. And that the current funding of 119 billion is 572 billion rands more than the target set by the trustees. So we are in a crisis as a country. We must try and think innovatively how we get ourselves into the crisis. And the last one, which is where we are now, we've got this huge financial markets, as everyone was saying. JSE market cap, 24 trillion. Bond market, 6 trillion. 30 trillion. It's 3 times GDP. But there's no investment. Why? And then we have non-bank financial institutions, assets of 20.5 trillion, and we've got banks, 8.0 trillion. How do we point this huge financial sector towards, it is growing, but it's not investing in the economy? And lastly, Sandile, my conflict of interest, I did present to the Patsita conference at Sun City. Thank you. So I think the solution is that we must have a developmental financial sector. It starts with the central bank. We need developmental targets for banks, for lending to black SMMEs and labor-intensive sectors. That's number one. Number two, we need developmental target for non-bank financial institutions. I would say about 5% gives us about 1 trillion rands over 7 years. And we can innovate in terms of the institutions that we set and the instrument. I believe that the instrument must be very simple. It must be an inflation-linked, possibly a zero-coupon bond. We must accept that it will have lower returns for pension funds and provident funds, and we mustn't dodge that, but it has huge returns for society, what Thobile was talking about. So the biggest benefit for society, what Thobile was talking about, is an economy that grows and creates jobs. And we must stop measuring what we are trying to do by these, because all the problems that you were talking about here, and these complicated things, and the last thing I want to say is that private markets cherry-pick prime customers. And when Mr. Zungu was speaking, I just checked a calculation I did. 15.7% of people are in medical aids. Only 22% of them have comprehensive cover. I remember I had an interview with the Deputy DG of Health, Nicholas Crisp, and he says, I've just had an operation on my back, and I came to see you in the office. I can't afford this medical aid, and I'm the Deputy DG, and I only have hospital cover. So the private sector only provides cover to 3.5% of the population, comprehensive cover. So I'm just saying that 2/3 of our population lives below the upper bound poverty line. So most of them are unbankable. So I think we must be realistic as to how can we get this financial sector to serve the people, as Thobile was saying, yeah, because the biggest return has to be to society. Thank you.